SCHD is the gold standard of dividend ETFs. I own it. You own it. And after its 2025 reconstitution, it's stronger than ever with cash cows like CocoaPhillips and Merck. But here's the dirty little secret no one on the internet tells you. That 3.5% dividend yield will barely keep up with inflation. If you want real income, you need to look beyond ETFs. Enter Hercules Capital, ticker HTGC, a 10% dividend powerhouse financing the tech and green energy booms. This isn't some niche stock. It's a $2.5 billion titan with 20 years of dividend payments, 133% portfolio growth last year, and special dividends every quarter for 5 years straight. And right now, you can buy HTGC at fire sale prices, thanks to the recent 15% market overreaction. Let's put this in perspective. SCHD gives you $3,490 a year on $100K invested. Steady, safe, but HTGC delivers $9,650 per year on that same $100K. Life-changing. But before you buy even a single share of HTGC, you need to hear this one warning, because there's a hidden risk no one's talking about, and if you ignore it, you could lose your shirt. I'll reveal the full truth at the end of this video. More importantly, I'll show you the exact strategy to collect $1,000 monthly in dividends with HTGC without doing anything crazy. But first, let's talk about the biggest myth in dividend investing, that all high-yield stocks are traps. It's why most investors never even look at companies like Hercules Capital. But this blanket fear is costing you thousands in potential income every single year. There's a massive difference between a yield trap and a legitimately high-yielding business. Companies like Enterprise Products Partners, EPD, have increased dividends for 25 straight years while maintaining a 7% plus yield. Or Realty Income, ticker O, has paid 640 consecutive monthly dividends. These aren't traps. They're cash-generating machines with rock-solid business models. Hercules Capital belongs in this elite category. But most investors have never even heard of it. Let me fix that right now. HTGC is what's called a business development company, or BDC. These special companies provide financing to businesses that traditional banks won't touch. And the government gives BDCs massive tax advantages if they pass 90% of their profits to shareholders. Hercules specifically targets high-growth companies in technology, life sciences, and renewable energy. While SCHD holds established blue chips that will weather any storm, HTGC finances the disruptors creating tomorrow's breakthroughs. But here's what makes HTGC truly special. They've been doing this since 2004. They survived the 2008 financial crisis. They navigated COVID. And through it all, they've maintained one of the best track records in the entire BDC industry. So, how exactly does Hercules Capital deliver these massive 10% yields without cutting corners? The secret isn't complicated. It's just different from what you're used to with index funds. HTGC isn't buying stocks hoping they go up. They're making secured loans to growth companies at interest rates between 9 and 13%. When you're collecting double-digit interest payments, it's not hard to pass that cash flow to shareholders. Let's look at their latest financial results. In Q4 2024, Hercules reported net investment income of $81.1 million. That's 49 cents per share. Their regular dividend is only 40 cents per share. That means their dividend is covered 123% by their earnings. This is crucial because sustainable dividends must be covered by actual earnings. HTGC isn't borrowing to pay dividends or selling assets. They're generating real cash flow that more than covers their massive payouts. And there's more. Hercules doesn't just pay regular dividends. For nearly 5 years straight, they've paid additional special dividends every single quarter. They only pause these extra payments during COVID. For 2025, they've already announced they're paying special dividends in all 4 quarters at 7 cents per share each. That's on top of their regular distribution. With all this, you must be wondering, If HDGC is such an amazing opportunity, why you haven't heard every financial website screaming about it? Good question. That is how you have to think as an investor. You see, financial media is obsessed with hyping the same mega-cap tech stocks and popular ETFs. They ignore stocks like HDGC because smaller BDCs don't generate the same clicks and ad revenue as dropping big names like Palantir, Nvidia, or Tesla. And that's exactly why it's such an opportunity right now. The less attention a stock gets, the more likely it is to be mispriced. And right now, HDGC is severely mispriced after its recent 15% drop. In just a moment, I'll show you how to collect $1,000 dividends from HDGC. Before that, let's see why the stock is a bargain at the moment. To understand why it is a bargain, you need to understand why it fell in the first place. Two major events hit HDGC simultaneously. First, the entire market took a nosedive when Trump announced new tariffs. The S&P 500 fell nearly 2.7%, and the NASDAQ tumbled 4% in a single day. This dragged down almost every stock, including HDGC. The second reason was specific to Hercules. On March 5th, they announced a $250 million convertible note offering. To many investors who don't understand how BDCs operate, this looked like bad news. But it is actually the opposite. Here's why. BDCs are required to pay out 90% of their earnings as dividends. This tax advantage is great for shareholders, but it means BDCs need to raise capital to grow. The most solid BDCs regularly do debt offerings to fund new investments. This isn't dilution, it's growth capital. Hercules will use this money to make new loans, which generate more interest income, which funds even larger dividend payments. Since February 19th, these two factors have pushed HDGC down more than 15%. But nothing about their fundamental business has changed. Their earnings are strong, their dividend is secure, and their non-accrual rate, that is, the percentage of loans not performing as expected, is just 1.7%, well below the industry average of 3.8%. This is a classic market overreaction. We've seen it before with HDGC. Last August, the stock plummeted on similar fears, only to fully recover a few months later. This pattern repeats because most investors are emotional, not rational. But before you rush to buy HDGC, I promise you complete honesty, and there's something critical you need to understand. Hercules Capital isn't risk-free. No 10% yield ever is. The specific risk with HDGC comes from their business model. They specialize in venture lending, providing financing to younger, more speculative companies. While traditional BDCs like Main Street Capital focus on established businesses, HDGC targets emerging growth companies. This creates an additional layer of risk. If multiple portfolio companies fail simultaneously during a severe economic downturn, HDGC could be forced to cut its dividend. It happened during the 2008 financial crisis, and it could happen again. But here's what most investors miss. HDGC's management has done an exceptional job managing this risk. On their latest earnings call, CEO Scott Blinn revealed that just one debt investment on non-accrual out of their entire portfolio. One. And they're actively working to recover that investment. The key to investing in HDGC isn't ignoring the risk. It's understanding it and being compensated for it with that massive 10% yield. Now, let's get to what I promised you. How to generate $1,000 per month in dividend income. I'm not going to tell you to dump your entire portfolio into HDGC. That would be reckless. Instead, I'll show you something much smarter. Combine HDGC's massive yield with SCHD's reliability to create the perfect income stream. SCHD gives you rock-solid safety with its diversified portfolio of quality dividend growers. HDGC gives you massive yield. Together, they create the perfect income combination. Here's how to structure your portfolio. For every $100,000 you have to invest, put $80,000 in SCHD and $20,000 in HDGC. With this allocation, SCHD will generate about $2,800 annually, 3.5% on $80,000. HDGC will generate about $2,000 annually, 10% on $20,000. Total annual dividends, $4,800, $400 per month. To reach $1,000 per month or $12,000 annually, you need approximately $250,000 invested in this 80-20 ratio. But you don't need all that money up front. Start with $100,000 today in the same ratio. Reinvest all dividends, and you'll reach that $1,000 monthly income in about 7 years. Start with $150,000, and you'll get there in roughly 5 years. Or begin with $175,000, and you're looking at just 3 years until you hit that $1,000 monthly milestone. This is the power of dividend compounding. Your money working harder for you every single quarter, accelerating your path to financial freedom. But whatever you do, avoid these 3 critical mistakes that destroy most HDGC investors' returns. Mistake number 1, buying at the wrong price. HDGC typically trades between $14 and $19 per share. The ideal entry point is between $16 and $18, exactly where it's trading right now after this recent dip. Mistake number 2, panic selling during volatility. HDGC drops 15 to 20% at least once a year. It's normal. Investors who sell during these dips lock in permanent losses instead of temporary paper ones. Mistake number 3, not reinvesting dividends during accumulation. If you don't need the income yet, reinvest every cent. At a 10% yield with quarterly compounding, you'll double your money in under 7 years, even if the stock price never moves. Now that you understand the strategy and the numbers, it's time to make a decision. Let me be blunt. You have 2 choices. Stick with SCHD alone and need $350,000 to make $1,000 monthly, or add HDGC and need just $250,000 for the same income. This is your moment. While everyone else is frozen in fear, you can position yourself for massive dividend income. The strategy is simple. The math is clear. The opportunity won't last. I'm Andrew, and if you love this video, you might also like these too. Consider watching them and subscribing to the channel, and I'll see you there.